Welcome back to Watching Corporate Eye. We've got Sarabjit Kour, Nangra, VP Research Angel Broking joining us. Sarabjit, let's come to you first with your reactions as far as the Dr. Reddys observations are concerned for their Duvada facility. 13 observations. How serious is this and what kind of revenue implications do you foresee?
See, in terms of seriousness, obviously it is serious in the sense that Dr. Reddy is unlike its peers like Lupin and all, who have been somehow managing their US business and are not dependent on few products to drive their profitability because they're getting regular approvals. So Dr. Reddy is weaker in comparison to other peers or other pharma companies in that respect. So obviously complex generics was something they were looking forward to in terms of, they spend a lot in terms of R&D also in their business in developing such products. So they were looking forward to approvals from such products to drive the growth and profitability and establish a good portfolio of products which would have some niche and would have more pricing power than their older portfolio. So definitely currently I don't think it should have a much of impact because as a proportion complex generics is not very great right now, but I guess it holds pressure for their revenue generation and future, and the dependence on para for kind of an opportunity definitely will increase. And this is one company somehow unlike other pharma companies who have not been so dependent on para-4s, is the one which depends on some of the one of these opportunities coming along every year so that their US business or their growth kind of earns a respectable number. So I guess from that respect, yeah, growth will be under pressure and they will depend on new product approvals, more so para-4 kind of an opportunities where they have exclusivity to drive their growth. So I guess from that sense it's a setback from future number onwards. But I guess these are normal course of things for pharma companies to face on their in their business in US. So I guess something which can't be forecasted or ruled out also for any company for that matter. So yeah, now the only thing is patience that will be tested for Dr. Reddy in terms of business and stock also. So I guess tough times for the business per se. As far as my call on stock goes, I think the stock is already corrected when this news was out with respect to the API and other facility long back. So I guess it's not much of a damage left to be done there. So I guess in terms of valuation, downside is restricted. So I don't foresee much downside happening there because of this news actually.
All right. Speak to us a little about the R&D cost side, Sarabjit, because I'm assuming at the end of the R&D period, once the launches would have happened from here, a lot of that cost would have been capitalized, right? Because typically we see pharma companies doing that. Any pressure from the cost side seen? So if you are talking about a postponement of revenue accruals and also continued pressure on the R&D cost side, what kind of an impact on margins do you see going ahead? Because I understand that revenue might not be accretive as of now, but the cost period would just become a little more protracted, right?
No, they have already done that kind of investment. If you look at Dr. Reddy's R&D cost for last couple of years, like other pharma companies, has been on the higher side actually. So they have been regularly investing in these complex products and technologies. So to that extent, they have been investing, yeah. So that's why you see Dr. Reddy's margin as it is under pressure in comparison to other peers. Because of not so much under pressure, they are still at, like last year they finished at 25. This year I'm expecting them to finish at 18. In spite of R&D costs being much higher, I'm assuming 15% percentage to sale R&D kind of a cost. In that 18%, given that this year most of the pharma companies were straddling with domestic business being under pressure, US being under pressure, is a good job. So in terms of profitability, I'm not so worried. It's revenue stream that I'm worried about actually. Revenue in the sense more towards from the growth perspective. So that gets delayed. So what they're normally working at is probably say OPM of around 22 will remain 22 probably. That's not a worry, which is a decent margins at which any pharma functions, and commendable given that they're spending 15% on R&D. But yeah, being an investor, I expect those things to monetize faster, because even though if they are not hitting my bottom line, they're not adding to the top line and increasing my returns more than what I want. So I think return ratios definitely get suppressed. So from that respect, I guess margins, I'm not so worried, the thing that you asked. And secondly, it's only that the growth gets delayed from such complex products, say 1.5 years from now on, assuming that they are able to rectify the situation and take control or take charge of that. And in terms of stock, as I earlier said, I'm not worried, because stock has already done its bit in terms of, coming down heavily this year, underperforming. And so it's factoring in most of the things possibly going wrong with Dr. Reddy. So in terms of stock, I'm not worried, and I don't see much of a downside possible in the stock. And like most of the pharma companies, I expect next year to be slightly better, primarily, if nothing else, on the base effect, because most of the pharma companies are doing 30% to, depending on company to company, 20, 30 to 40% from domestic markets. Companies like Dr. Reddy are more dependent vis-a-vis Lupin and others who are just 20% or less than that in domestic. So domestic market, just because of the base of this year being lower, I think next year on the base, the growth will bounce back. So probably next year is taken care for most of the pharma companies just on the base effect. But I guess with Dr. Reddy, it will be a tough time, because as I said, Dr. Reddy is not so aggressive in terms of product approvals, and depends a lot on generic para 4s to come in 1 year, or probably and contribute and increase its profitability. But overall, yeah. So from Dr. Reddy's perspective, tough time if these complex products don't come to market faster, because they have, as I said, they have invested a lot in terms of R&D in these products. So probably if they don't happen in, say, next 1.5 years, probably that's a max. I think a shareholder probably expects that should take to rectify. If that doesn't happen, then things could prolong for Dr. Reddy in terms of its growth in US, which is its key market. So from that perspective, it's a peculiar problem for Dr. Reddy and less for others. So I think for Dr. Reddy, this event becomes more worrisome from that perspective. Unlike other companies like Lupin or Cadila, it would have happened. Probably they would have managed the growth by doing many other things. But in case of Dr. Reddy, its dependence on US and its dependence on para 4 or opportunities which are niches more, to make sure that the growth is better than the peers. So I guess that makes it more peculiar for Dr. Reddy. So I think, yeah, the thing should, I think, play out favorably in next 1.5 years. Then I would have said they have rectified the situation. Otherwise, it could become more difficult times for Dr. Reddy, actually.
Fair point, Sarabjit. We're going to leave it at that, but thank you so much for joining us with a quick take on what your view is as far as the 13 observations are concerned, and how pertinent this is from the revenue accretion standpoint. The stock is down 4.4% and is holding out with those kind of cuts as of this point. Let's focus on company-specific issues then. There's Dilip Buildcon. They've issued an exchange filing, and they've completed a project 400 days prior to the execution timeline. Rohan Suryavanshi